All right, this episode we are talking about Roth IRAs. If you are a worker, a young person, a professional of some sort, someone who has earned income, you may have heard of a Roth IRA, and it is an investment vehicle that has some great benefits. And so let's start off with, what is a Roth IRA?
Yeah, so a Roth IRA is a retirement account. By the way, IRA stands for Individual Retirement Arrangement. I thought you might want to know that, so that's for free. A Roth IRA is a tax-free IRA, and so what that means is there's two types. One, you get a tax deduction in the year that you contributed it for, and so if you contribute let's call it $5,000. Then on your tax return, you can get a deduction for that $5,000. With a Roth IRA, you don't get that tax deduction this year. So you've paid money on that $5,000. You put it in the Roth IRA, and then when you take it out for certain qualifying distributions, the one that usually comes to mind is age 59 and a half, because it's a retirement account. There's just some other reasons you might pull out that money. When you pull out that money, it's tax-free, and so all of that growth that you've had in that account is tax-free, as opposed to the other form of an IRA, traditional IRA. If you get that tax deduction in the year you contribute it, then at the end of that time, then you'll pay taxes on that distribution.
Yeah.
So they're kind of opposites in that way. So they're both tax deferred. One of them you get out tax free in retirement. The other one you pay taxes on in retirement.
Yeah. And as advisors, we like the Roth IRA as it gives flexibility. We like money in different accounts. One could be a 401k or a traditional IRA. One could be a taxable or a cash account. And then the third one would be a Roth account. That way, in retirement or even before retirement, you have several options, and you're not limited to just one thing on where you can take money from. We love the Roth IRA because it grows tax-free, and you can take it out tax-free after the 59 and a half or some other qualified rules. But we like to say it's kind of a life hack because of those reasons. And because of that, because it's a life hack of some sort, the government only allows you to contribute up to a limit of $7,000 if you're under 50, $8,000 if you're over 50.
In 2025.
In 2025, that's might go up or down depending on the year. We've seen it go up over the last few years. And so you can only do that up to the maximum amount. What you don't just open the account and it starts growing. You have to actually invest it. I've seen lots of videos online where people put their max contribution in and they think they're doing a great thing, which they are. And then they realize that they haven't invested it. They look back after 5 years and, I thought this account was such a great thing. And so,
but you have to invest. And so it's kind of two things that you have to remember, that like make the contribution, but contributions are made typically in cash, and so once you do that, then you have to invest it in some sort of, or you don't have to, but you would do well to invest it in the stock market or in bonds or a mix of both.
Another key benefit is that there are no RMDs. So an RMD is a required minimum distribution, and essentially for let's say an employer account like a 401k or a traditional IRA, the government says you have to take out money and pay ordinary income tax on that. With Roth IRAs, you don't have to take it out at a certain age. So we'd say that's a benefit.
Absolutely. Yeah, and to go along with that, I mean, that just makes me think of like inheritance. And so the difference between that and an IRA, I know this is probably more than you asked for, but is that when your beneficiaries inherit that, if they're named individuals, then typically they can take it out, or there's no requirement on taking it out over 10 years, they have to distribute it by that 10th year. And the difference between that and an IRA is that they would still have to take those RMDs over the 10 years.
Mm-hmm.
So Roth IRA, take it out by the 10th year typically. And then an IRA typically is every year you make those distributions. So same idea to what you were saying.
Yeah. And then when you do get the inherited Roth IRA, you don't have to pay tax on what comes out of it, which is awesome.
Yeah, gravy.
So are some limitations. We're not going to go super in depth with that, but based on the amount of income you make, either single or married filing jointly, you might not be able to contribute. But there are some ways around that. You may have heard Roth conversions or backdoor Roth conversions.
Backdoor, something like that. Backdoor Roth is what I call it. Yeah.
But there's different ways to get it into the Roth account, even if you are over the income amount. There's a 5-year rule on once you put money in, you can't take out the earnings unless you've waited 5 years. If you put money into it, you can take out the money that you put in. So it's still your money.
And the earnings, if you take it out after the 5 years, there's like a penalty too.
There's a penalty
on the earnings. So unless it's a qualifying. Oh gosh, this is so complex. There's a penalty unless it's qualifying distribution. So there's.
If you have more in-depth questions, just go ahead and give us a call or a message, and we'll
That's right.
nerd out over Roth IRAs.
There you go.
But how can I? All right, so we talked about it. Where can I open it up, and how can I start this today?
Yeah, so there's a ton of custodians, and so you think of the big ones like Schwab, Fidelity, Vanguard, those type places. A lot of banks would help you do it. They can help you work through it. So there's even some we call them like robo advisors that will invest your money for you, so it'll take care of what you said earlier, where you put your money in cash, they'll do it all for you. So yes, there's a lot of places you can open and fund a Roth IRA.
And another good tip is that it goes by the tax year. So right now it's 2025. By April of 2026 I can still contribute to the 2025 Roth account. And so there are some time limits, and that's kind of a beneficial one if you start a little late. But yeah, make sure you get those contributions in if it's right for you in your financial picture.
Yeah,
I think that might be everything. This is one of those ones, if you're a young professional, you don't want to wait on this one.
And just thinking about we call it the time value of money. Like $1 today is worth more than $1 in a year, because you can invest the dollar today and it can go along with the stock market and hopefully grow over time. Whereas if you fund it with that same dollar in a year, you've lost all that time. You haven't enabled it to grow. So start now.
Yeah. Past performance does not.
That's right.
We hope for your investments to grow. But Roth account is a great investment vehicle, especially for younger earners that aren't at that income phase out yet. That's one of those investments where you can set it and forget it, and by the time you're 60, maybe it could be worth something.
Yeah,
so
absolutely.
Hope you enjoyed this episode, and hope you learned something a little bit about Roth IRAs. So thank you.